All right, so just like we've had in the past, we're going to continue to have some PowerPoint videos. Our next chapter, we've done chapters 1 through 7 in the class. Now we're going to move to chapter 8, and we're going to be looking at liabilities, primarily current liabilities. And we're going to be looking at all of the components of the stockholders' equity section. So with that said, let's take a look at some of these objectives for the chapter. We are going to spend some time on current liabilities. We're going to very briefly talk about the concept of bonds. Bonds are a type of long-term liability, so they're usually not going to be a current liability. We're also going to talk a little bit more in depth about concepts of common and preferred stock. This may be something that has given you some trouble. What your chapter outline does not talk about is retained earnings, but we're going to review retained earnings as well. And then we're also going to talk about how the declaration and subsequent payment of cash dividends impacts the stockholders' equity section of the balance sheet. Okay. So, before we can talk about, on any rational level, current liabilities, we need to understand what a current liability actually is. And it says on your slide that a current liability is a debt that the company will expect to pay either from existing current assets or through the creation of other current liabilities, and these are paid within 1 year or the operating cycle, whichever is longer. Okay. Now, normally a current liability, let's go back up to number 1 for a moment, and let's talk about this. When we say we're going to pay it from current assets, what are we talking about? Well, primarily what we're talking about here is cash. We have a bill that is a current liability, a debt, an obligation. We are going to pay that obligation through current assets, specifically most of the time through cash. Okay? We're not really going to get into this too much, this second item here, but we can sometimes do kind of an in and out process where we take care of, we borrow from Peter to pay Paul, essentially. We get rid of one debt by creating another debt. Okay? Refinancing would be an example of that to some extent. And then again, we're going to focus on liabilities that are going to become due within 1 year. In fact, most of the liabilities, the obligations that we're going to look at are going to come due in much less than 1 year. Okay, and we have some examples here at the bottom. We're going to go over some of these. We won't have time to go over everything, however. It says current liabilities include notes payable, accounts payable, unearned revenues. Unearned revenues is most definitely a liability. And then we have some accrued liabilities such as income taxes and payroll taxes, salaries, and interest. Okay, if we know that we're going to be paying interest, we would simply call that interest payable. Okay, I should probably point out also that notes payable can be current or non-current. Okay, they can be current or non-current. All right, so let's take a look here at some characteristics of a note payable. Note payables are a form of written promissory note, and what that means is that these are essentially formal contracts. Much the same way whether you go and you borrow $500 from one of those payroll loan companies, or whether you buy a house for $500,000, you'll have a note payable that is witnessed by a promissory note. Okay? In the real world, you will pay interest on borrowings that you make, depending on the type of note payable, the duration of the note payable, the collateral that has been laid down to back up that loan, or the lack of collateral. All of these things will have an impact on the interest rate that you receive, but you will pay some amount of interest. Okay? Now, your next item here says frequently issued to meet short-term financing needs. Well, that's because when we're talking about notes payable right now, we're talking about notes payable as a current liability, and if a current liability has to be paid within 1 year, for the most part, then we would be talking about debt of a short-term nature. Okay? I've kind of alluded to this fourth item here. We can have notes payable for very, very short periods of time, such as 3 or 4 months. We can also have notes payable for several years, even decades potentially. Okay? And again, because we are talking about current liabilities, payment is normally going to be due within 1 year of the balance sheet date. Okay, so if we have a loan that we have taken out for, say, $2,000, and we did that in July, and that $2,000 has to be paid back in 9 months, well, that entire $2,000 note payable is going to show up in the current liability section of the balance sheet. Okay? All right, so here we have a little example. We have two parties to this business example. We have a lender, First National Bank, right here at the beginning, and we have a borrower called Cole-Williams Company. And this bank has agreed to loan $100,000 to Cole-Williams at an interest rate of 12% for a period of 4 months, with the note maturing on January 1. Okay? So, let's take a look at how this impacts the balance sheet of Cole-Williams Company. Well, they borrowed $100,000 from the bank, so when they got that $100,000, assets, specifically cash, went up by $100,000. But because this is a 4-month note, they've also increased their liabilities by $100,000. And again, because it is a 4-month note, all of these liabilities are current liabilities. They're going to have to pay this entire note back in less than 1 year. Okay? So that's all we have going on here. This is simply to recognize that we received $100,000 from the bank, and we also have created a $100,000 obligation to that same bank. So, remember, in this class and in any accounting class you take, we are going to be dealing with what is called the accrual basis of accounting. So we recognize revenue expenses, liabilities when they are incurred, not necessarily when they are paid. Now, you're going to have to do a little math on this to understand what's going on here. But let's jump back a couple of slides, let's jump back one slide. It says that they borrowed $100,000 at 12% interest. Well, 12% times $100,000 is $12,000, yes? Yes. But they only borrowed that money for a 4-month period of time. Well, we know that there are 12 months in a year, and so if we were to take 4 over 12, we would simplify that to 1/3. So we're only going to be paying, or Cole Williams Company is only going to be paying 1/3 of that $12,000. We multiply 100,000 times 12%, but only 1/3 of that. So we could essentially say that this 12%, we could actually just use 4. 4 is 1/3 of 12. However you want to do it is fine. The point being, they're going to owe the bank $4,000 in interest. Okay, they're going to owe them the $100,000 that they borrowed plus $4,000 in interest. Not $12,000, because the note was only for 4 months, not for 12 months. Okay? So because they know that they're going to do this, they would establish a liability for $4,000. Now, this is not the way that everybody would do this. Not all businesses would actually put this liability on the books. Okay? But we are talking about accrual basis accounting, and this is what should happen. Okay? When we recognize that liability, we have an immediate decrease to retained earnings. So if we think about this, that makes sense because we say that assets equals liabilities plus owner's equity. Well, we didn't have an asset that went up here, but we did have a liability that went up. So in order for all of this for the accounting equation to hold true, we have to hit retained earnings for $4,000 as soon as we recognize this liability. And here we have the actual math that I had forgotten was here. $100,000 times 12% times 4 over 12 months is your $4,000. I've already talked about this somewhat, but when this note actually matures, remember we said it was going to mature on January the 1st. They borrowed the money on September the 1st. That's a period of 4 months. They're going to pay the face amount plus the interest. So this is what we have happening in terms of our accounting records. Cash is going to go down $104,000. $100,000 that they owed plus the $4,000 in interest that they owed. Liabilities are going to go down by $100,000 because we paid the money. We satisfied that liability, the note payable, and we also satisfied interest payable. Again, the accounting equation stays in balance because assets have gone down by $104,000, liabilities have gone down by $104,000. Okay, so I want to talk to you a little bit about the concept of unearned revenue. I really need you to understand that unearned revenues are liabilities. Unearned revenues are not assets and unearned revenues are not revenues. Okay? Unearned revenues are, what did I say? Starts with an L, liabilities. Okay, so this is, even in the definition of unearned revenues, we have a little bit of confusion because it says that they are revenues that are received before goods are delivered or services are performed. Well, if we're receiving revenues before we have earned them, accrual basis of accounting, right? Then we have revenues that are not yet earned, okay? So we cannot recognize these revenues over on the income statement, at least not yet, okay? So we'll have an example here in just a moment, but what happens if we were to think about this from a journal entry perspective or a T account perspective? If we got $50,000 in unearned revenue, cash would go up because we got the cash, but so too would unearned revenue, right? So if we know that cash is an asset, well, unearned revenue cannot be an asset. Right now, cash went up, so this can't be an expense, and I've already tried to tell you that it's not the same as a regular revenue, so that only leaves one choice for our unearned revenue. That's liability. Okay? Eventually, when the company earns the revenue, would be a better way to put this, rather than recognizes that when the company earns revenue, it's going to decrease unearned revenue, and it's going to increase the actual revenue account. This is over on the income statement. In fact, it's at the very, very top of the income statement. Okay, so we have some examples here at the bottom of the slide. Let's say that you're going to go on vacation. You buy a ticket for your vacation next month. You pay for that ticket, but the airline has not provided you with the flight service yet. Therefore, initially they're going to have unearned ticket revenue. When the flight occurs, whether you're on it or not, they have ticket revenue. Okay, you paid $300 for the ticket. Initially, we have $300 of unearned revenue. You go on your vacation, you get the flight service, ticket revenue goes up by $300. Unearned ticket revenue, the liability, goes down. All of these other two examples are the exact same thing, so I'm not going to discuss them, but those are also very good examples of unearned revenue. Okay, so this is an example that I have used in class before. We have Superior University sells 10,000 season football tickets at $50 a pop for each of its 5-game home schedule. The sale of season tickets on August the 6th, which is a little late, quite honestly, for season tickets, and the completion of the game on September the 1st are recorded as follows. So remember, they got the money for 5 home games, but now they've played one of them. So let's look down here. What it says. It says on August the 6th, they got $500,000 in cash. So assets went up by $500,000. Unearned ticket revenue, liability, if you don't believe me, it's right there in black and white, also went up by $500,000. Okay? Let's fast forward now. Take a little trip in our time machine, and we go to September the 1st. We've played one game. We've played one game. All of the tickets are the same price, okay, regardless of the game. So now we have earned $100,000. We haven't earned $500,000. We've earned $100,000. So we would recognize that $100,000 earned over on the income statement as $100,000 in revenue, okay? And we would reduce our liability. Now, this makes some sense if we think about it. We still have a liability of $400,000, okay? Still have a liability of $400,000. We have $500,000 in cash. We have $400,000 liability, and we have a $100,000 impact to stockholders' equity via revenue coming through the income statement, flowing down through to net income, and then into retained earnings. Okay, we've talked about that before. For whatever reason, this concept tends to be a sticking point for some students. All right, unearned revenues. Don't let it confuse you. Just remember that it's tricky, and you'll probably remember that it is a liability. We have a little notation here. This first transaction increases cash flow, yeah, because you got $500,000. However, this second has no impact on cash flow. Why? Because we didn't get any additional cash. We already got it back in August. Okay, so we talked just briefly about notes payable, and I told you that note payables could be current liabilities or long-term liabilities. The reality is that when they are a long-term liability, they're actually both a current and a non-current liability simultaneously. Okay? Well, if you don't know what I'm talking about, let's just stay with me for a second and hopefully we'll get there. When we talk about this concept of current maturities of long-term debt, we're talking about the portion of a long-term debt, portion of a long-term liability that comes due in the current year. Okay? So let's look at this example they give us. It says Wendy Construction issues a 5-year interest-bearing $25,000 note on January 1 of 2016, and this note specifies that every January 1st, starting on January the 1st of the next year, 2017, Wendy should pay $5,000 of the note. Okay? So when they say $5,000 of the note, we're talking $5,000 of the principal. Their actual payment was almost certainly more than $5,000. How much more? Doesn't matter. Doesn't matter. Okay? So, it says, when the company prepares financial statements on December the 31st of 2016, what amount should be reported as a current liability? What do you think? How much is due? How much of that obligation is due within the next 12 months? That is going to be the deciding factor, okay? The answer is $5,000 because they owe $5,000 within the next 12 months. Okay, we don't have any indication that their operating cycle is something more than 1 year. So $5,000 is going to be a current liability at the beginning of this note. $20,000 would be a long-term liability at the beginning of this note. When we get to the final year of the note, okay, this is not on your slide, but it's good information to have. When we get to the final year of the note, all right, then we would still owe $5,000, and that entire $5,000 would be a current liability. Okay? What amount should be reported as a long-term liability? Well, I already told you, $20,000. Okay, let's see what the next slide says. All right, very good. So at this point, if you are actually in my class, you should have all of the information that you need to answer all of the questions on the first handout, which you will find in your course module, your most recent course module. You will also find a video where I work out the problems on the YouTube channel. So if you get stuck anywhere on those, there is some relief for you that way.